In 1919, the US had emerged victorious from World War I. A mood of optimism was in the air. Britain and its European allies were exhausted financially from the war. But the US economy was thriving, and the world danced to the American tune.
The uncertainties were over. There seemed little doubt about what was going to happen. America was going on the greatest, gaudiest spree in history, and there was going to be plenty to tell about it.
In the 1920s, everyday life was changing. Electrification transformed America. Towns were hooked up to the grid.
This is the flowering of consumer culture and mass consumption on a scale never before seen. There is also heavy installment buying to encourage people to buy big-ticket consumer items so that they can buy those items on credit.
This type of consumer credit was another innovation of the 1920s. For the first time, the idea of buy now, pay later hit the mainstream.
And there's a kind of play culture that develops alongside this consumerism, which says, we believe now in instant gratification. Take care of the now. Don't worry about the future. Live for the moment.
There was a whole ideology that we were in a new economic era, that it was the birthright of every self-respecting American to be rich.
With easy credit and more disposable income, Americans were now looking for new ways to get even richer. Since World War I, the US government had sold bonds, known as Liberty Bonds, to pay for the war. This was a way to borrow money from the public, who in turn would receive interest payments on the bond's value. Celebrities such as Charlie Chaplin and Douglas Fairbanks had been recruited to promote them at huge rallies.
Liberty bonds caused many people to become investors in securities for the first time. For the first time in their lives, they got interest payments every 6 months, and the security was something they could trade on the market, so they could look in the newspaper and see what the price of my bond is today.
Liberty bonds created an investing culture. Most people had never purchased securities before, and it got ordinary people accustomed to buying securities.
Now there was another group of people who thought they could take advantage of this new investing culture. The bankers of Wall Street. For years, Wall Street, the center of American finance, was made up of a small elite group of bankers doing business with each other in a society closed off to the general public. But one man saw an opportunity that would change the face of the financial world. Charles Mitchell, president of National City Bank, spotted a lucrative gap in the market.
Mitchell saw that investors had purchased a lot of government bonds during World War I. And so he said, now we have an investing public there, all we need to do is market other products like corporate bonds, common stocks, and just tell people these are respectable investments.
Mitchell was a natural salesman with a big ambition. If people were willing to buy bonds to raise capital for the government, surely they could be tempted to buy stocks and shares to raise capital for private companies listed on the New York Stock Exchange. And they could make a profit for themselves in the process.
Gradually, people who never dreamed that they would invest in stocks were doing so, and stocks lost a lot of this stigma. Historically, stocks had been considered much too risky for ordinary people. Whereas in the 1920s, there was a sense that investing in stocks was not only safe, but reliable and respectable.
The idea took off, and to exploit this lucrative new market, Mitchell opened brokerage offices all across the country, where people who had the money but not the investment know-how could speculate in stocks and shares.
This speculative frenzy embraced all kinds of people, not just professionals. Ordinary people began participating as well in unprecedented numbers. all across the country, not just New York City, but in cities, in small towns, all across America, people were in love with the stock market.
Technology made it all possible. The latest share prices flashed from Wall Street could be printed out within minutes across America using telegraphic ticker tape machines.
You could find ticker tape in nightclubs, in railroad depots, in beauty parlors, on ocean liners. The market became a pervasive part of America's play culture in the 1920s.
The American investing public began to connect the products they were using that were coming from corporate America with the notion that, hey, I might own a share of the company that makes that product that I like.
By the mid-20s, around 3 million Americans were in the market, and Wall Street gripped the public imagination. With tales of fortunes being made overnight, the idea of a great bull market, where shares only seemed to go up, took hold.
Every popular magazine, every newspaper, every radio station was fascinated by what was going on in the stock market.
People had so much faith in the bull market that they borrowed increasing sums of money to speculate on rising share prices. This way of buying shares was known as buying on margin. The investor was required to put down only part of the money, with their broker funding the rest. The culture of buy now, pay later had spread to the stock market.
Buying stocks on margin means essentially that you're buying them with borrowed money. By the late 1920s, 90% of the purchase price of the stock is being made with borrowed money.
There were no rules about how much you could borrow, and people borrowed enormous sums of money to buy stocks. You could buy a $100 stock for $25, and then the brokerage firm would loan you the other $75. And if the stock went up, and in the late 20s everything seemed to go up and up, then that $25 could turn into investment that was worth $200 or $300. So it became a huge part of the U.S. economy to loan money for the stock market. In fact, in the late 1920s, nearly 40 cents of every dollar loaned was for stocks.
This vast influx of borrowed money into the stock market created more demand for shares, pushing prices ever upwards. In 1928, the market went up by almost 50% in just 12 months. And as stocks continued to rise, more and more investors borrowed money to get a piece of the action.
It was a prosperous period. Business was making money. Wall Street was making money. The politicians, I think, just said, well, everything's fine. The economy's growing. The market takes care of things pretty well, and the government's job is to get out of the way.
While amateur speculators were transfixed by the soaring value of their investments, they were hopelessly unaware of how Wall Street really worked. With little government supervision, the market was a law unto itself, and insider dealing was rife.
There was a lot of market manipulation going on. It was rampant. There was no disclosure at all to speak of. And when Wall Street was very small and very self-contained, that was probably okay. But as people like you and me began to put our hard-earned money into the market, then it really mattered.
The stock market of the 1920s was neither fair nor democratic. It was a big gambling casino, and it was rigged by professional speculators.
As smaller investors gambled with their life savings, they failed to realize that the odds were stacked against them. Men like Joseph Kennedy did not make their fortunes by simply picking the right stocks. The truth was that they were cashing in on the naivety of gullible newcomers.
A bunch of sharp speculators would get together, and in coordinated fashion, they would start quietly but relentlessly buying an individual stock.
What they would do is hype up a particular stock, buy it up themselves, and then dump it on the market so that they took the profits while the average investor in those stocks were left with the losings.
Even some of the elite investment houses on Wall Street were engaged in this type of market manipulation.
A prominent and highly respected banker, Paul Warburg, broke ranks with the Wall Street aristocracy and issued a bleak warning.
If orgies of unrestrained speculation are permitted to spread too far, the ultimate collapse is certain to bring about a general depression involving the entire country.
My great-grandfather issued a warning in March of 1929. He actually used the word a depression, and he was shouted down. I think he was disregarded. He was, a party pooper. I mean, no, everything's fine.
Everybody's making money and having a good time at the party. So when there's a good bull market going on, the person who says this might be getting overvalued, you better be careful, he's sort of dismissed.
Blue sky, smiling at me, nothing but little blue signs. Do I see? Bluebird.
Warburg's prediction fell on deaf ears, and between May and September 1929, 60 new companies were floated on the New York Stock Exchange, adding more than 100 million shares to the marketplace, fueling the investment bubble.
You hear the same things in every bubble. This time is different. It's a different financial world. It's a new financial world. In fact, Groucho Marx went to his broker at some point and said, I just don't understand how these prices just keep going up. And the broker said to him, well, you just have to understand that it's a global economy now. And this was 1928, 1929. Gee, I think I've heard that sometime since then.
Some professional speculators sensed that the market was overheating. The more astute got out during the summer.
One day, apparently, Joe Kennedy, according to Joe Kennedy's later recollections, he said, if the shoeshine guy knows as much as I do about the stock market, maybe it's time for me to get out.
In September, the market became increasingly volatile. Behind closed doors, President Hoover's unease was growing.
Herbert Hoover did keep making inquiries among his Wall Street friends, asking if he should be concerned, and he received a memo from Thomas W. Lamont, who was the senior partner of J.P. Morgan and Company.
Grandfather said in that letter, the market will correct itself, and there would not appear to be any need for any kind of government intervention in the market.
Lamont reassured Hoover that there was absolutely no cause for concern, and the memo ended with the line, "The future appears brilliant."
Outside, the crowds continued to wait for news. Rumors were fueling the mounting panic.
Once the crash is underway, the real question becomes one of confidence. When you lose all confidence in the economy, good and bad go down together. And so the chief investment elite is at great pains to try to restore that confidence, to convince people that the economy and the stock market is sound.
The bankers knew they had to do something to avert a total financial meltdown. A Times journalist watched events unfold.
The crowd grew thicker and noisier, and then there was an eddy in the middle of it, and a man in shirt sleeves was pushing his way across the street in the direction of the Morgan offices. This was Charles E. Mitchell, chairman of the National City Bank. He pushed his way into the offices of the House of Morgan, and a little later, we learned what he'd gone for.
Charles Mitchell had been summoned to a meeting at the offices of J.P. Morgan. Around the table were four other leading bankers, including Richard Whitney, vice president of the New York Stock Exchange. These were some of the wealthiest businessmen in America, representing around $6 billion in assets. Chairman was Thomas Lamont.
What they came up with was a plan to put together a pool of $250 million. And those funds would be used to support a key list of stocks.
At lunchtime, Richard Whitney marched across the street back to the trading floor of the stock exchange. With a huge injection of the bankers' cash, Whitney hoped to get the market moving again.
Whitney parades over to the desk where U.S. Steel is being sold and buys 25,000 shares of U.S. Steel at a price well above what it was then selling for, and then makes a similar promenade to other blue chip stocks and makes a similar purchase. The idea being we will now restore everybody's confidence in the market. And other great financial titans of the time, including John D. Rockefeller, make similar purchases, hoping that this symbolic act will turn the tide.
And it worked. Such was the magical power of the Whitney name and the Morgan name that stocks suddenly turned around and started to go up.
By now, news of the meeting had leaked out, and journalists were desperate for information.
Grandfather was meeting with a group of reporters who were assembled on Wall Street outside of his bank office. His style was always to stay calm and never say anything that would that would erode people's confidence in the stock market.
Silver-haired Mr. Lamont received us with a manner so reassuring. It was like the man who comes on the stage of a burning theatre and urges everyone to keep perfectly cool, stating there is no cause for alarm. There has been a little distressed selling on the stock exchange, and we have held a meeting to discuss the situation. We have found that there are no houses in difficulty, and margins are being maintained satisfactorily.
Grandfather and many others felt that the worst was over, but they were very, very wrong.
Over the weekend, the bankers' interventions seemed to have worked. Trading on Friday and Saturday was calm and uneventful. President Hoover also tried to steady nerves by repeating a mantra that has been used during market crashes many times since.
The fundamental business of the country, that is production and distribution of commodities, is on a sound and prosperous basis.
But in the offices of the financial district, there was total chaos.
One of the things that we forget is how primitive the technology was. So many stocks traded on October 24th that it took 4 hours for the ticker to print all of the stock trades after the market had closed.
The ticker, hopelessly swamped, fell hours behind the actual trading and became completely meaningless. All night long, the lights blazed in the windows of the tall office buildings, where margin clerks and bookkeepers struggled with the desperate task of trying to clear one day's business before the next day began. They fainted at their desks. The weary runner fell exhausted on the marble floors of banks and slept.
On Monday, with stock tickers running out of tape, panicking investors desperate for the latest share prices jammed the telephone lines between New York and other major cities. For the first time, many speculators were discovering the downside of easy credit and buying on margin.
A fairly significant number of people who were buying stocks in the 1920s were buying it with borrowed money. And of course, the wonder of buying stocks with borrowed money is that the gains are tremendously accelerated and magnified on the way up, and then of course on the way down the entire machinery is thrown into reverse and the losses are also magnified.
All these people who had borrowed to buy stock now had to put up more collateral. And this was something that had not happened as the market had gone up and up. You've got $25 down for a $100 stock, but now if the stock has dropped. So what happened is the brokerages that had made all these loans got very concerned that the loans wouldn't be paid back. People got calls to bring in more cash or their stocks would be sold.
Account needs $600. Unless this amount received before 1 p.m. Tuesday, we'll sell all securities in your account. Consider this notice to that effect.
And that's a difficult thing to do. Some people didn't have additional cash to bring in, or they took them some time perhaps to do it, but the brokers were very uneasy. They couldn't wait. And so Monday, the market begins to fall even at a steeper rate than it fell on Thursday. In fact, this would turn out to be one of the very worst days ever in the history of the United States stock market.
On Tuesday morning, some of the most famous names in corporate America saw their share price plummet. U.S. Steel, Radio, General Motors, stocks that had been symbols of the boom years.
On Tuesday, there were tremendous waves of selling that just kept coming. This time the selling was so powerful and so relentless, there was no lunchtime meeting at J.P. Morgan. Clearly the volume of the sales overwhelmed any possibility of the bankers trying to stem the tide.
By evening Tuesday, all American stocks were worth about 22% less than they were when the market opened in the morning on Monday. 36 hours, you lost 22% of the value of American industry.
Hoover was president, and he and Andrew Mellon, the Secretary of the Treasury, were way to the right and felt that it was not the government's job to interfere with this. They believed in pure, unfettered capitalism, and so they did very little or nothing to alleviate the crash. They said it'll solve itself. The market broke very sharply, and a lot of people were wiped out with it. It was very painful. Almost everybody lost money, as has happened now.
By the end of these 5 days trading, $25 billion worth of personal wealth had simply disappeared.
The stock market continues to sag without end. Have orders in to sell everything. I figure I'll have about 500 left if I'm lucky. A humble ending to a potential profit not 4 months ago of nearly 100,000. At least, I say to myself, I lost all in the greatest panic in history.
Not everyone coped with their losses. Although the number of suicides has been exaggerated, to some it seemed the only way out.
I know that people read about the stories on Wall Street of people opening the windows in their offices and jumping out. That actually happened. That isn't an urban legend. People did commit suicide. People who had worked 30 and 40 years on Wall Street and had amassed fortunes within a period of days lost everything.
Yesterday, a woman jumped from the roof of our building, 44 floors, right past our window. I saw her body lying in the street, and the sight was so harrowing that I became half sick.
The effects of the catastrophic crash on Wall Street rippled out across America. Even those who had never owned shares and who had never benefited from the stock market boom became victims too. The crash had undermined Americans' faith in their fragile banking system, made up of thousands of small-town banks that lacked the size or reputation to convince customers that their money was safe. As confidence in the economy sank further, a domino effect began. In 1931, over 2,000 banks failed.
After the crash, the banks closed. That, I think, affected us a little more seriously, us, meaning us, the people of my stature. Many people had money in the bank, little bit of money, a couple of $100, $1,000 maybe.
There was no infrastructure then. There was no Federal Deposit Insurance Corporation to guarantee people's deposits. There was no way to back up the banks. So if the banks had made bad choices, you as a depositor paid for it. You went to go get your money, it wasn't there. And then people would hear that the bank down the street wasn't good, and they worried about their own bank, and then that would cause a run on their bank. And it became a terrible, vicious cycle. And something like 3,000 banks closed in the following couple of years after that. The whole financial system then seemed not just unstable, but worthless.
After that, when people saved money, they were very leery of banks, and money went under the mattress.
The stock market crash in 1929 did not create the Great Depression, but it did start a sequence of events that eventually culminated with the Great Depression.
Well, some of this is going to sound sort of familiar. The banks were loaning money for the stock market, the companies were loaning money, the brokerages were loaning money, and when those prices fell, all that money just disappeared. almost immediately, companies began to feel the pinch of not having the capital and of having lost money, and they began to lay off people, to let people go, to shut down production.
There were mass bankruptcies. There was a liquidity crisis of exactly the same kind we have today. That is to say, all kinds of businesses could no longer get loans to keep themselves afloat, even if those businesses were entirely solvent. They couldn't get the kind of short-term commercial credit to pay their workers, to buy new inventory, to pay their suppliers. And so they began going bankrupt. And as they went bankrupt, they laid people off. And as they laid people off, demand fell. And this is what does traumatic damage to the whole society, so traumatic that it's second only to the Civil War in American memory as a tragic moment in American history.
There was such a change in our lives and all the people around me after the crash. Many of my girlfriend's fathers lost their jobs, and they couldn't pay the rent. They were evicted. The poverty was really all around us. Men had no clothing. They were in rags, really rags. They used to wrap their feet up in newspaper and put them in cardboard, makeshift shoes to walk around the street. And then if you took a walk over to Central Park, you saw this big area, a deserted reservoir that had been drained. And they made little huts of cardboard boxes, and they would sleep there overnight. And they called it Hooverville, because that was the name of our president at the time. And of course, all this stock market crash and all this poverty was, of course, put in his lap. It was really, really pitiful.
The Great Depression would last until the outbreak of World War II. Then, as now, the globalized economy meant that the crash and subsequent depression rippled out across the world. The lessons from the crash of 1929 are that history repeats itself, that human folly and greed are much stronger forces in financial affairs than reason and restraint.